Well, Cliff, thanks for joining us today. Appreciate you stopping by Forbes. A great place to start. You're not a guy known for being shy about your opinions and your convictions. Let's talk about this fiscal cliff issue.
Sure.
Huge factor in the investment landscape, huge factor politically. Give us briefly sort of your take on where we are.
Sure. I think it's certainly a huge factor politically, and it can be a huge factor in the investing world, because the investing world often involves a lot of psychology.
Right.
I actually have a bit of an odd view on it. I think it's a big economic event, but a little less big and a little less cataclysmic than others do. I start out as a pretty strong cynic about Keynesian economics and stimulus and whatnot, and usually think of that as being a kind of naysayer and saying this isn't going to work. But it also works in reverse. When they're going to stop spending something, and if you're a cynic about government spending having a great multiplier effect, you have to also make sure you remember to apply it in reverse and say it's also not so terrible when they slow down.
Right.
Now, there are parts of it that are very upsetting. Without getting into a philosophical argument, you can feel anything you want about marginal tax rates. But that's something Keynesians, free marketers, the real business cycle people, pretty much anyone in economics agrees the disincentive from higher marginal tax rates slows growth.
Right.
Again, you can believe it's worth it for other reasons, but that's going to be a negative. And it's just not the way the number one power in the world is supposed to settle its affairs. It introduces certain chaos and uncertainty that we just don't need, particularly at a time when we haven't completed recovery. Mm-hmm. So I'm by no means saying the fiscal cliff is a positive. It's a without a doubt a negative, but I think it's less of a cataclysm than some others do.
Right. Now, Mark Lazary, who runs Avenue Capital, who, another very well-regarded hedge fund manager, said earlier this week at a conference I was at that, one of his concerns is that the way Wall Street looks at a problem is they look at it and then they try and solve it. The way Washington looks at a problem is they look at it, then they think about how they can solve it and how they can be perceived solving it. Do you agree with that? Is that
yeah? Mark's right about Mark's and I politics differ slightly.
Right.
But when it comes to matters of logic, he's a guy you want to bet on. Mm-hmm. That's a great way to put it, actually. When you come to your investors at the end of the year, if you're good, you should have many more good years than bad years, but you'll have bad years too.
Right.
But ultimately, long term, it's the numbers that count. In politics, it's who's perceived as the loser, right? It's almost like there's this famous old Keynesian beauty pageant where you don't pick the most beautiful, you pick who everyone else thinks is the most beautiful. It's not who has the best idea, who's perceived as having the best idea, who's perceived as being willing to negotiate. Both sides, you watch the press conferences, both sides, while being pretty intransient, and I will not share all my partisan views because it's not the forum for it. So anyone watching will see it through partisan eyes and think their side is being more flexible or whatnot. But both sides seem to stress not only their plan, but also the absolute intransience of the other side and whatnot. And they're clearly trying to manage the fallout, mm-hmm. not just the event. Also, you can accuse Wall Street people of being too short term, but if you plan to have a 20, 30-year career and you run a money manager like Mark or I run, eventually it's going to catch up with you. The returns are the returns. You can't fake it.
Right.
In this case, people do politics for X number of years, and then it's somebody else's problem. So the kick the can down the road strategy might sound very silly, and we might all laugh at it. But you always got to think, what's the rational action for the person? It's a terrible thing for society, but it's not that irrational act for the person sitting in the seat. Why should I take the blame and get yelled at for all the tough decisions?
And not get reelected.
And not get reelected because I had to give bad medicine out to people. We'd all love to have courageous politicians who kind of look like Jimmy Stewart and act like Abe Lincoln and whatnot, who are willing to take it on their shoulders, but they don't come along too often. It might be too high of a standard to hold them to. So it's a very long-winded way of saying yes. I think Mark's analogy is a very good one.
All right, so that's perception side. Let's talk about the market, and let's talk about perception versus reality in the market. I know you're a long-term thinker. You're not looking to do things for the next 6 months or the next year. But as we look out into 2013, we've had this incredible run in fixed income, particularly in quote-unquote safe assets like
Right.
U.S. Treasuries. What do you see in the investment landscape? People talk about inflation, and it doesn't matter until it does matter, right?
Right. Well, these are the hard questions. When I talk about these things, I back up, and for the long term, not for the short term, what price you buy something at versus fundamentals. It matters a lot. I won't say it's all that matters. You can have fundamentals act weird for 10, 20 years. More often than not, though, if you buy an asset very expensive to its fundamentals, for stocks, that's versus its earnings, versus its book, for buying a price that's very high or very low. For a bond, it's buying at yields that are very low versus inflation or very high versus inflation. That is a reasonably strong indicator. In fact, it's our best indicator of how you're going to do over the long term. Looking now versus history, versus kind of the 70, 80, 100-year history we all like to look at, stocks are on the more than on the expense. They're about 80th percentile. I use geek terms like that. 80 out of 100 times they're cheaper than they are today on my favorite metrics to look at. And bonds are about 98th percentile expensive, meaning low real yields. Putting it together, this is where I'll depress the entire World Wide Web. Putting it together, you take 60% of where stocks are and 40% of where bonds are. That's about the least attractive ever. Our best guess is a US 60-40 portfolio will beat inflation over the next decade. And again, it's a best guess.
And when you talk 60-40, you mean stocks
bonds?
and
bonds.
Yeah.
Will beat inflation by between 2 to 2.5%. Historically, that portfolio, with a healthy amount of bonds, so it's not that risky a portfolio, has delivered 5% over inflation. You can ask yourself a lot of questions. Does this mean forever people are comfortable, the risk premium's lower and we'll make 2 forever? Right. Or are people fooling themselves and at one point are going to wake up and go, no, we really want 5 like history, in which case prices have to fall. Here's where I get to be a coward and only talk about the long term. Picking between those two scenarios is very hard. But where this comes in most importantly is planning purposes. In some ways, the whys and the whens don't matter that much. If what you're doing is sitting and saying, how much do I have to save to retire? If you're an institution saying, how much do I need to put away for my liabilities? The fact that the expected from here is 2-3% lower versus inflation than normal, the very least, even if you're not willing to market time, and maybe you shouldn't, by the way, I'm not necessarily advocating that.
Right.
But I am advocating using the current valuations in your planning process, acknowledging reality and saying, does that mean you have to save more, spend less? Whatever it is, they're sad messages. But if you're going to earn 2.5 instead of 5 over inflation, it changes your equations.
Right. Now, you said your preferred metric earlier. You were talking about one of your preferred metrics. You were talking about the PE, the Schiller PE, which is a 10-year look at prices versus earnings. It's not the last 12 months. It's not the next 12 months. It's more of a broader look. There are critics of that, of course. Why do you like that metric when you look at it?
I don't want to put words into John Campbell and Bob Schiller's mouth, who came up with it. I'm going to tell you why I think they did, and I think they'd agree. But the idea is particularly in using P's, there are other things you can look at. You can look at book values, dividend yields. Right. But if you're looking at earnings, one of the Wall Street's longtime favorite metrics to value a stock or the stock market, earnings is a little ambiguous. Over what period do you use earnings? Do you use future forecasted earnings or current trailing? I'll tell you right now, I hate future forecasted. They are always wildly optimistic and I don't trust them.
I just read today that fourth quarter earnings estimates have been cut in half since October 8th by analysts. Hardly the kind of thing that's steady.
They use optimistic forecasts, then they bring them down all year, and they also tend to focus on what's called operating earnings, which are often sarcastically called earnings excluding bad things. Now, what Bob and Schiller and John Campbell said was 1-year P's can be very weird. 1-year earnings move around a lot. When they're very high versus, imagine you have a trend. Earnings have grown over time. Thankfully, as the economy has grown, earnings have grown. So earnings have grown over time, but imagine they're way above trend. They tend to mean revert. In geek speak, they tend to fall back to the trend. If you look at a 1-year PE at that time, the E is a little artificially inflated. Something good has gone on that maybe won't last forever. And you'd be using a PE that says it's too cheap. On the other side, it could be even more extreme. When earnings are low, we've seen entire market earnings perilously close to zero. Now, I'm not going to get into a ton of math here, but anything divided by zero is coming out pretty close to infinity. And I don't know, I might be more negative than most, but I don't think stocks are infinitely expensive. That would be a little odd. So what they basically said is what we really want is price divided by some idea of earnings capacity. How much could they earn in a normal world? And they said if I just use a 10-year average of what inflation-adjusted earnings, it's unbiased because I'm always going to use a 10-year average. I'm going to use that 20 years from now. I used it in the past. and they said a 10-year average captures the economic earnings power of the companies in the country. I think it does also. I don't think, by the way, they would be married to 10 years. Their concept is to use a longer window. I've joked in the paper we wrote that if you told those guys, hey, how about 8 years or 12 years, they wouldn't run screaming. There's no magic to 10 years.
Right.
Right now, 1-year earnings are above trend. 1-year earnings have been strong. A few years ago, they were below trend. I think a few years ago, you'd be too pessimistic using 1-year earnings because PEs would look too high.
Right.
And right now, they look too low. Some of the critics you've talked about, and this is a raging controversy among 9 of us. I don't know if that qualifies as a raging controversy. There aren't that many people that interested.
It's not quite to the level of fiscal cliff,
Yeah.
but
but the criticism now is not about the technique. Most people writing about it have said it's a pretty good idea to smooth these things, not to use 1 year. But right now, this 10 years is a very weird 10 years. This 10 years includes the earnings destruction in 2008. And now it's pretty much rolled out, but when this fight started, it included in the early days some of the earnings destruction post the tech bubble. Right. So is this too pessimistic? And I wrote a short piece, really a very simple point, saying if you actually plot not 1-year earnings, but 10-year earnings, they're above their trend too. It's not been a bad 10 years, it's been a good 10 years.
Even with the effects
Even
of 2008.
with the 2008 wipeout. And I can't prove this, but logically, and you can see it in the graph, 2004, 5, 6, and part of 7 were strong earnings. We were in that bubble time. So it's kind of cheating to go, let's not count those 2008 earnings.
But let's count the perhaps
let's
artificially
count
strong.
or use or ignore the fact that it's just a give back.
Right.
And the numbers seem to bear that out. That the 10-year, you see nothing to make you think the 10-year is any less valid than the past. And historically, it's been a far better predictor of the next 10 years' earnings than the current earnings are. So I see no argument on the other side. I mean, I'm trying to be nice about this, but I don't see their point.
Yeah. So it may not be a panacea, but it is a potion for this short-termism that can so often take effect. And
exactly, and you know, at the peak of the tech bubble, the Shiller PE got to maybe 45. We're at about 21, 22 now. I'm not predicting a new tech bubble, but at some point, some geek like me was sitting there saying, well, 21's pretty high. And they look like, it might have been me actually, then they look like a complete idiot 7 years later when that 21 turns into 45. So this is not something necessarily to try to time the market on. It is something that works out more often than not. If you look at history, the 10-year periods have been considerably lower when Shiller PEs have been higher, and they've been considerably higher when Shiller PEs have been lower, when you've bought at cheap times, but not all the time. Right. In that same paper, we show best and worst cases. Here's the good news. The best cases are still very good even from high Shiller PEs. Sometimes it works out.
Right.
The bad news is the average case and even the best case is much lower. So even if it works out, it doesn't work out to the same degree as when you buy cheaply. So again, I would not want anyone to run out and short something or sell something based on hearing this. But I would want someone to think maybe there's a chance he's right. It probably will be. The smart money will be the returns will be somewhat lower than the past, and I should plan for that in my life, if not make a big allocation decision.